Silicon Valley Bank. Unless you've been under a rock for the last couple of days, you've probably been hearing a lot about Silicon Valley Bank and the fallout that's happening with these banks and the bank runs and the bank contagion and some of the things that we can actually have seen and some of the fears, some of the greatest fears of people when it comes to banks and banking institutions are being realized or have been realized. And also at the same time, having huge announcements from the FDIC and from the government that they're going to back it up and they're going to protect it. So there's a lot of things happening right now. And so what I'd like to do is share with you really quickly what happened, kind of an overview of what's going on, and then some key takeaways, some things that I'm going to be doing moving forward, and some things that I would advise you would at least take a very serious look at and then maybe seriously consider what you ought to do moving forward as well. So let's get started and let's check things out. My name is Paris Clough and this is Financial Self-Reliance. On this channel, I love helping people manage, protect, and grow their money. And in this video, we're going to talk about some of the important things that we can learn on how to manage, protect, and grow our money, regardless of what's going on in the macro economy or in the overall economy. There may come a day, we've seen it in the past, there may come a day when we have an economic collapse and economic failure. In fact, we saw it in 2008. We had a bank run in the early 1900s with a Great Depression. So some of the things that are in place today are because of those things that we've learned and some of the things that we've learned as a country. So we have laws and rules and things in place to help protect us. But there's also some things that we can learn as individuals and as people from these experiences, especially more modern experiences, and what we can do to manage, protect, and grow our money for ourselves and become more self-reliant on how these things work, and using these tools like banks, using tools like investment accounts for our benefit rather than feeling like we're being used by these banks and by these institutions and we're the ones that are being used. So let's get into a few things. First of all, Silicon Valley Bank is a bank that's located in California, and it had a huge situation this last week where it actually was seized by the federal government because it went defunct. And there's some reasons why it went defunct. And so we'll take a look at that. And there's some lessons we can learn about why that bank went defunct and how we can manage our own money in the process. So the first thing to think about there's a lot of information that's coming out still, but one of the things that kind of struck me is that 2 weeks before they had this announcement of going defunct and not having sufficient assets to be able to continue, they were actually audited by one of the big auditing firms in America, and they were given a very high rating, like they were going to be able to move forward and everything was going to be great. So sometimes, I've heard a lot of stories where people will go to the doctor and then a few days later they're having a heart attack. So just be careful with these auditing situations. Take them, they're valuable. There's something that we should add to our portfolio, or add to what we're doing when we do our due diligence. But just remember, because an auditor says that everything's good, may or may not be the case after all. So it's good to trust but verify, as I always say. So that was an interesting situation. Also, something to think about is they gave huge stock bonuses to their CEO a couple of weeks before they announced this, and like $3.5 million of stock bonuses went to their CEO, and he was able to cash out. So really not really feeling sorry for him. In fact, there might be some impropriety there based on some of the things he might have known coming down the pipeline. So what really ended up happening in this situation was that in 2019 and 20, Silicon Valley Bank received a ton of deposits, and it got a lot of money into their bank from a lot of these startups. Now, Silicon Valley Bank is traditionally a bank that's being used by venture capitalists or people who want to start a new business. They will use Central Valley Bank because they're actually kind of catering to that marketplace where they're giving loans and making it available to new startups. And we'll go through a list of some of the companies that have used those startups here in a minute. But it was interesting that they took all this money in, and then all of a sudden, and so one of the things that banks do to make money is that they'll invest that money in other assets, and then hoping those assets will produce a result for them. What they do is they'll invest the money. So you deposit money. This happens from every bank, by the way. You deposit money into a savings, what they call a savings account, and then they'll take your money, and through fractional reserve banking, they'll go and lend some of that out, and they'll earn a higher interest rate. So any bank, any credit union, anybody you see where they're offering you 2 or 3 or so percent. In fact, most commercial banks are offering 0.001% or something ridiculous. It's not even worth it. in their savings accounts. Well, they'll take that money and they'll go earn 1, 2, 3, 4% on it, and they'll pay that 1%, 0.01%, or whatever ridiculous amount that they pay you in the savings accounts, and then they keep the difference. They keep that, what's called a spread. It's called arbitrage. It's a financial term for you borrow money at a lower amount and then you invest it earning a higher amount, and then you keep the difference as your profits. So they ended up investing a ton of money into long-term treasury bills. Now, one of the problems, are treasury bills bad? No, in fact, treasury bills can be a good investment right now for most people, but the problem was the liquidity issue. They locked up their money for 10 years, I think, and that's not good. So liquidity is a crucial element to this whole debacle. And so let's put a pin in liquidity, and we'll come back to it in a minute, because that's one of the lessons that we can learn. So they purchased these bonds at a certain rate that they were going to be able to earn at maturity. So once the bond was up, they would have the money back plus all the interest that they would get. Unfortunately, the bond market changed because of inflation and because of what's going on with the Federal Reserve and Jeremy Powell. They're increasing the interest rates so fast, so much that the bond market actually now is way better than that lower amount, and they had they were losing money now. If they held on to these bonds, they would actually end up losing money because the interest rate they were getting was nowhere near what it could be, or ought to be, or is now. And so because of that, they were concerned, and the depositors were concerned. In fact, I'm not exactly sure what triggered it, because there's still a lot of stuff going on. But one of the things that was problematic is that they realized the insolvency, or somebody realized something was happening. The stock prices fell dramatically, and then all of a sudden there was a run on the bank, and they withdrew. I think some of the people were told they withdrew $42 billion in a 24-hour period. $42 billion being withdrawn. They had $80 billion was invested in these bonds that they had made. They had to sell those off and lose a couple of $1 billion in order to be able to provide the liquidity for the $42 billion plus whatever else they were working on. I mean, the bank itself is valued at $209 billion. So we're literally talking about more than half of their value was just decimated in a 24-hour period, potentially. 42 billion is like what, 25%. 80 billion is, just under like 40%, something like that. So add those two together, or maybe they're not a part of the same number, but the point is that a significant amount of assets was reduced. This bank they lost a lot of their liquidity, lost a lot of their money, and they weren't doing what they were supposed to do. And one of the things that's coming out now, as we see, is that they actually were more worried about pronouns than they were about profits. And they were more worried about some of the environmental issues and climate change and some of these other issues than really making sure that what they were doing on the bottom line for producing a profit was being taken care of. So I think that's another lesson that we can learn from this as we move forward. Now, what I'd like to do is, now that you kind of know and understand what happened, let's take a look at some of the lessons we can learn from the bank and what I'm going to do personally in my situation. So one of the things that I realized is that it's, if you have all your eggs in one basket, it's never a good thing. And so anybody that had a whole bunch of their assets, like any of these businesses that had a bunch of assets in the bank, they had all their eggs in one basket. So let's take a look at some of the companies that were involved. So just so you know, this is a website here called Natural News. Anyways, they have the USDC, which is cryptocurrency, stablecoin, was run by Circle. That was one of the companies that had their money with Silicon Valley Bank. Roku, BlockFi, Roblox, Ginkgo Bioworks, Rocket Lab. I'm going to make a shout out right now to my future son-in-law. He loves Rocket Lab, and because this bank was bailed out, Rocket Labs might be able to continue to move forward. Maybe it's a good time to buy while that stock is low, because a lot of these companies, because of this bank, the stock market just took a dump. And another great lesson about that is that when the stock market dumps and you have cash that's sidelined, you can buy in to these companies at a lower price. Now, that's hoping that they're going to go back up, and so you got a deal because you came in at a low price. They go back up to what they were after all this settles, and things are good. But if these companies go out of business and you bought low, well, you just lost all your money. So there's several here that QuantumScape. There's several others here that you can probably pause the video and look at this list if you want to, but I just wanted to give you that idea. I had a client, I had a friend of mine reach out and say, Paris, with this bailout, this FDIC stuff, who pays for that? And I said, well, literally the taxpayer is going to pay for that. Now, this is kind of a funny headline. This is another one here. The non-bailout bailout. So tell me that they're going to get a bailout without telling me they're going to get a bailout. So it's funny, or tell me that interest rates aren't going to continue, or inflation isn't going to continue to go up without telling me it's going to continue to go up. So when the country may or may not, be through taxes, but it will definitely be through inflation as the Fed continues to print more money in order to take care of these companies. So if the Fed, what basically happened is that Silicon Valley Bank sold their T-bills to the Fed, and the Fed gave them the money that they needed to be able to do this. Now the Fed owns an asset that has lost money. So where does the Fed get the money to be able to take care of that? Well, then they just print the money. So if they're printing more money and putting more money into the system, then that's actually the same thing as quantitative easing, which is actually why we've gotten into the problem in the first place with all the inflation that we have. So it's like, did we really fix the problem, or did we exacerbate it, or did we push it down the road a little bit further or a little bit too far? So something to think about as things move forward. So a couple of real key things here is that one is I want you to recognize that the FDIC insurance just changed overnight through this Biden announcement. The FDIC insurance was supposed to only insure somebody to a $250,000 balance. Now that's per person, per social security number, per account. So you have to remember that that's put in place for a reason. Well, Biden just said, doesn't matter how much money you had, we're going to back you up regardless of that amount of money. Well, where does the money come from for that, first of all? Second of all, that's setting a precedent now that for all future banks, did the banking industry just get subsidized by the federal government? So did we just lose the ability to have the capitalist system with our banking systems? There's some things to think about here. Another thing is that FDIC insurance is, a lot of people think that's some government agency, and it's not. It's actually Federal Depository Insurance Corporation, and it's a corporation that, of course, has regulations and, of course, works very closely with the federal government. But the name Federal Depository Insurance Corporation is what goofs people up, because they think it's a federal agency when it's not, because of the name of the corporation. It's a corporation that's completely owned outside of the government, but they work with the government, and the government does have some oversight, or supposed to have some oversight, on what's going on. So anyways, the point is that there's some real wake-up calls that we all need to be aware of as we're moving forward with this economic situation that we're in. So Silicon Valley Bank was the 15th largest bank in America. And if they can have this kind of situation happen, there's a reality that we need to take a look and see who else. Other banks actually have started to falter. And we had another one, Silvergate. We had another one, I can't remember the name of it right now, but probably several dozen banks started to have some real solid fluctuations and some real big problems because of this, and people with that fear of a run on the banks. And what is the fear? The fear is that we're going to lose the money that we have. So if you have all your eggs in one basket, the fear is going to be higher. If you don't have a lot of savings, the fear is going to be higher. If you haven't properly diversified your assets, the fear is going to be higher. So here's the lessons that I'm going to learn. One is, I actually counted. I have money in 1, 2, 3 different credit unions. Now, credit unions are run different than banks, but still, it's something to consider. I have 1 commercial bank, and I have 3 non-commercial, they're 3 smaller banks. I have 1 high-level Wells Fargo, basically, 1 bank account there. I have several accounts with that bank, but I have 3 other checking accounts or savings accounts with 3 other different banks. So I personally realized, not knowing this, I actually have a diversity in where my money is in the banking system. So I would highly recommend you do the same thing. The other thing that a lot of people are talking about is gold and silver. I love gold and silver. I think you should have some gold and silver. I personally believe that 20% of your total overall net worth ought to be in gold and silver. Most people are saying 5 to 10%. But the one thing that I love about gold and silver is not really an investment. And you're not going to buy it and then it's going to, increase in value over the next year. But what you're going to do is you're going to buy it, and it's going to be a store of value, meaning it's not going to lose like the stock market. The stock market, some stocks lost 40, 50, 60% in a day. Gold doesn't do that. Gold and silver don't do that. They don't lose that amount of money that fast. They're very stable. They're very secure. They go very slowly, or they go down very slowly. It's a really good store of value. I hold physical silver and gold. So anyways, I just think it's a great way to help you kind of hedge against some of these issues that are going on in the economy. I highly recommend you hold some cash. Have 3 to 6 months of expenses in a savings account that's different from where your commercial bank is. Have it in a different account. I've done all kinds of videos on savings accounts that I think are fantastic, high yield savings accounts. My high yield savings accounts are separate from my commercial bank, and they're separate from my credit unions. It's a totally different bank, and I had that money in a totally different place. So make sure that you're properly diversifying and doing things like that as well. The other thing is liquidity. I said we'd get back to this. Liquidity is critical. If you have your money tied up for too long, you're going to find yourself in a bad place. So make sure that your money is not tied up in CDs or in banking or in T-bills that are longer term than you can afford or you feel comfortable with. I would highly recommend 6 months to 12 months max. Anything longer than 12 months, you're taking a huge risk right now, especially as the economy fluctuates up and down so much. You're taking a huge risk. So what do I recommend some of the final thoughts, takeaways from this issue? One, we need to trust but verify. We need to make sure that there's banking institutions, there's laws in place, there's things in place, but at the same time, we need to have our money diversified properly. We need to have maybe a couple of different banks, maybe a couple of different credit unions, maybe some banks and some credit unions. Make sure that your savings and your checking are diversified in some places. Have some cash on hand, have some gold, make sure that you have food storage, make sure that you have water storage, make sure that you're prepared in case anything happens with the economy, because we're seeing a lot of weird things going on right now. And it's time to be self-reliant, and it's time to be better prepared. I hope that you got a lot out of this video. I hope that you got some takeaways. I hope that you're feeling, with all the fear mongering that's going about this, if we take a step back and we learn the lesson. Yes, fear is good when it causes you to rethink what you're doing and be a kind of a stoplight to, wait a minute, stop moving forward. Think about what you're doing. Be aware. Situational awareness here. This is economic situational awareness. Be aware of what's going on and move forward cautiously, with self-reliantly, and with some discipline, and we're going to make it through this. If you missed the last video I produced, go ahead and check it out here. Subscribe to the channel up here and check out this video that YouTube thinks you might like. Until the next video, have a great day.